the Federal Reserve cut the Fed funds rate by 50 basis points today on Wednesday, September 18th. The first cut since March 2020, so more than 4 years ago.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings.
So what's next for inflation, the economy, and for the labor market? We're going to get answers from Steve Hanke, professor of applied economics at Johns Hopkins University. Professor, welcome back to the show.
Great to be with you, David.
So, Professor Hanke, we're going to get your reaction to the FOMC press conference. I'll have a few clips ready for you to react to. But let's talk about inflation first. So, up until basically a few days ago, the chances of a 25 basis point cut were higher than a 50 basis point cut, which is what happened today ultimately. And so we're going to talk about why that flip-flop. But first, people want to know whether or not inflation is going to surge and reemerge now that the Fed cut by 50 basis points instead of 25 is what was initially expected prior to a few days ago.
The answer to that's unambiguously no. All this fuss about interest rates is kind of a tempest in a teacup. It's really a second order or third order kind of condition in a mathematical sense. The first order condition is what's going on with the money supply. Monetary policy is determined by changes in the money supply. And once the money supply has a significant change with quite long lags, a year and a half, you start getting changes in economic activity and inflation. And right now, the year-over-year rate of growth in the money supply measured by M2, David, is 1.26% per year. That's way below Hanke's golden growth rate of 6% per year, a rate consistent with hitting the Fed's 2% inflation target. So the money supply has really been growing, actually contracting, literally contracting since July of 2022. That's only happened 4 times in the history of the United States, or I should say the history of the Fed, since 1913. And all of those 4 contractions led to recessions. Actually, one of them, 1929 to 1933, led to the Great Depression. So this is just nonsense. This talk about, even Jamie Dimon, who usually is very sensible about things, is talking about the possibility of stagflation. It's just not going to happen. What you're going to have is continued downward movement in the headline CPI as well as the PPI because of this monetary slowdown and contraction we've had. That's baked in the cake. That is caused by the monetary contraction that started a long time ago. That's why it's baked in the cake. So what they did today is pretty much irrelevant from that point of view.
Speaking of the money supply, if you take a look at my screen, this actually is a frequently asked question from my audience to you. By the way, if you have questions for Professor Hanke, please submit them to us in the emails down below in the description. But anyway, going back to this chart, people are wondering whether or not this increase in the money supply by as an annual percent change basis is going to continue, because as you've rightly pointed out, it's been decreasing for quite some time. It was in negative territory, and now it's basically climbing back up in positive territory, growing at 1.2%. Still not at your golden growth rate for inflation to tick back up, but the trend is there for positive growth in the M2. So can you comment on this?
Don't get excited about this. This is people who are they're so drilled in the head with this data dependency. They're looking at these little tweaks and movements and think it's very significant. It's irrelevant right now. We'll worry about it if it gets up to 6%, and worry. We'll not worry about it. Actually, we'll be happy when it gets back up to 6%. We'll start worrying about it if it gets significantly above 6%. So people are looking at the wrong thing. They don't understand what they're looking at. They're looking at a chart and they see a little zig or a little zag and they think it's a big deal. No, it's irrelevant. The inflation is declining. It's 2.5%. It will continue to go down. It'll probably go below the 2% target next year sometime, because we've had this big contraction in the money supply. And all Powell did in his speech, he's an expert con artist. He's conned everybody. I like all the reporters in the audience taking notes and being conned by him. He essentially was saying, we have all the gauges just right. We know exactly what we're doing. And folks, we're geniuses. We're going to have a soft landing. No, we're probably going to have a hard landing and a recession because of this contracting money supply that I mentioned. That's baked in the cake. So not only the inflation is under control and coming down, but there's a little something behind the curtain, and that is the next shoe is going to drop, and that will be a recession. So,
Okay.
So it's not going to be stagflation. It's not going to be low growth and more inflation, as Jamie Dimon indicated we might have a problem
Yes,
with.
he did say that, and he said that is worse than a recession. Let's just comment on that since you brought it up. Is stagflation worse than a recession?
If it happens, it is worse than a recession, because it's a recession combined with inflation. It's the worst of all possible worlds. So it is what stagflation is bad news.
Are you liking the video so far? Well, before we continue, let me tell you about an innovative way to create videos, which I can tell you from personal experience can be challenging and time consuming. Today's sponsor, InVideo AI, makes the process incredibly simple. Whether you are a content creator, marketer, or business owner, InVideo AI transforms your ideas into polished, professional quality videos in just minutes. It's the world's most used AI video creator with over 10 million users across 150 plus countries. All you need to do is type out a text prompt. From there, you can get creative and fine-tuned ideas for your videos using just text commands. It's like having your own video editor on standby. And the best part, you can clone your voice and make it narrate the videos in your own voice in any language. It does the job of more than 10 tools packed into one and costs just $20 a month to start with. Scan the QR code on the screen here or use my code linked down below to get 2 times the video generation credits in your first month. Since you brought up reporters, take a listen to this question from a New York Times reporter.
Gina Smilik, the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
The labor market is in a good place. The economy is also in a strong place. I'm not sure why he said the labor market is in a good place, because just a few minutes prior to that, he said that the labor market is deteriorating, which is ultimately why he switched to a 50 basis point cut from what he said earlier in July, which is no consideration for a 50 basis point cut. That was the first question that was asked to him by a CNBC reporter, why he switched from his stance earlier in the summer, to no 50 basis point cut, to what he did today. And then his answer was because the labor market is deteriorating. And then he said to this New York Times reporter that the labor market is in good shape. So I'm not really sure why he did that, but I'll let you comment on this.
Well, he did. She handed him a softball question. The New York Times reporter echoes the Fed line. She's a mouthpiece of the Fed, so she knew what the answer was going to be before she asked the question, and why she asked it is, I don't know, because I haven't talked to her, but I read her, she's reporting heavily on the Fed almost every day in the New York Times, and many people, and there is a model that's been done actually by a former Fed researcher, and the model says if you get a big change, a 50 basis point increase in the unemployment rate, you're in a recession. And we've had that. So that is basically telling us that we're already in a recession, if that's the metric that you're using and the model that you're using. And the New York Times reporter has reported on this, as well as every other reporter in the world. So she wanted him basically to knock that story down.
Okay,
you follow what's going on. This is all an inside game. These reporters are almost as if they're employed by the Fed.
Well, okay, I don't know them. I can't comment on that. But to my
point, I can comment on that. I read them very carefully, and I know exactly where they're coming from. And to have access to the Fed, they have to repeat what the Fed tells them, and they have to spin the narrative that the Fed wants spun. And right now, everything is great. We're going to have a soft landing, and the Fed is brilliant, and they're doing a great job. That is what Powell wanted to say, and she allowed him to do that by knocking this question out of the park. Basically, it was a softball question, and that she said, "Well, if the employment rate goes up by so much, doesn't that mean we're in a weak situation?" She didn't use the word recession, but she had the narrative perfectly. She understands exactly what's going on.
But this is what I was talking about. This is the CN.
Yeah. Let me just interrupt.
Sure.
I apologize for that.
No problem.
Remember Hanke's 95% rule. 95% of what you read in the press is either wrong or irrelevant. And this is an irrelevancy.
All right. I'm going to ask you if this next clip is also irrelevant, but this is what I was talking about. Take a listen.
In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question.
He's basically citing sources that indicate the labor market is deteriorating, and then later on in the press conference, like I showed you with the New York Times reporter, he said the labor market is in good shape, the economy is strong. I don't know if that's a contradiction to what he said earlier with this reporter at CNBC, or does he mean to say that the economy was very strong, it just deteriorated slightly and is still strong?
No, this is number one. All these clips, you're in the spin room. This is a Fed spin room in there. So you gotta think. People have to put things in context. What is going on? The Fed is spinning the narrative, and the press is going to echo the narrative. Now, this is a perfect example of the problems you get into with data dependency. Yeah, some of the data looked good bad a few weeks ago. Then it looks better. Then it looks bad. It's all over the place. This data dependency stuff. This day-to-day data are irrelevant. They're second order conditions. So forget it. what you didn't get was a question, and you will not get one from the reporters because they don't understand it. You will not, and the Fed doesn't want to hear the question. That's the main reason. No one asked what's going on with the money supply and what has been going on with the money supply since July of 2022. If they would have asked that, he would have said it's contracting, and that usually leads to a recession, not a soft landing. And it's growing at way below the golden growth rate of 6%. It's growing at 1.26%. And that means trouble ahead. But that's not the spin. You think Powell is going to get up there and say, we've screwed everything up. We haven't been watching the money supply. We let it contract. And sure enough, that always leads to recessions. He did say one thing, by the way, on your question. You had that chart, put that Fed chart up with the money supply, that little uptick thing. You know, the Fred.
Yeah.
The Fred
Yeah. Yeah. Let me show my screen.
Okay. So you had one of your viewers, Cornelius Christensen, asked this question about the little uptick in the growth rate in the money supply. And what Powell said, he said, we're going to keep shrinking the balance sheet. Remember, you asked me about that. That was a very important thing.
Yes.
That's a lot more important than the Fed funds thing. That means quantitative tightening will continue, and it means we're not going to get the money supply shooting up anytime soon. That's what that means.
Okay. So what you're referring to is their balance sheet. So it's been shrinking ever since the beginning of, the middle of 2022. And so just to clarify, Powell, when he said he's going to continue to sell securities, that he's talking about shrinking the balance sheet some more from where it is currently?
Yes. And
okay.
And that means you'll continue to have this very slow growth in the money supply, undershooting the
How does the math work, Professor? How do we get a shrinking balance sheet but also increasing M2?
Oh, it's just the rate of change is increasing a little bit.
Yeah.
It's not increasing very much. And we get that because remember, the biggest contributor to M2 has nothing to do with the Fed. It's the commercial banks. And the commercial bank credit is growing very slowly at about 3%. That's a number that's still below that's growing at 3%. The Fed isn't contributing very much. And you end up with an overall picture of a 1.26% year-over-year growth, which is very slow.
Okay, so bottom line, do you agree? I think I'm asking you a question I already know the answer to, but do you agree with the Federal Reserve? Do you agree with Powell when he said that the economy is in good shape?
No. The economy is weakening rather rapidly. If you look at all of what's going on, it's getting weaker. We're going to go into a recession. And why do I know that? I know that because of what started to happen in 2022. And what started to happen? The money supply started contracting. It started shrinking, actually.
Powell also said, he was asked whether or not he is behind the curve by a reporter. His answer was no. He said that we're not behind the curve, but the 50 basis point cut today affirms our commitment to not become behind the curve. So,
well, he's so far behind the curve, it's unbelievable. I mean, this data dependency thing, by the way, if you're looking at day-to-day data, he's looking in the rearview mirror. He's not even looking forward. To look forward, you would have to look at what the changes were in the money supply and predict what impact with the lag those would have on economic activity and inflation. That's what's called monetarism, by the way. As you know, I'm part of that reptilian clan called monetarists.
What do you mean? Well, I'm not understanding the reference.
We're always, by the way, when it comes to forecasting, we're not reptiles. We're not going into extinction anytime soon.
Oh, I see.
John Greenwood and I, remember, let me remind you, who forecasted that inflation would peak out at 9%? using the quantity theory of money. John Greenwood and I did. We said it was going to peak out at 9%. It went at 9.1. We hit the bullseye. Who said then that it was going to start coming down and it would end this year at between 2.5% and 3%? Well, John Greenwood and I did, using the same monetarist model, the quantity theory of money, the equation of exchange, MV equals PY.
This is the dot plot that was released today. Now, so basically what you're saying is, what Chair Powell said, if the economy evolves as expected, the median participant projects that the appropriate level of the Fed funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. So we're expecting much lower Fed funds rate even from this level. You're saying that doesn't matter. It's not going to bring back inflation no matter how low it goes.
The dot plot thing is a lot of BS because number one, it's only about interest rates. It's not about the money supply and what's happening to the balance sheet of the central bank or what's happening to the commercial bank credit. But this dot plot thing. They're trying to manage expectations. That's what they call it. They're trying to manage your expectations. Now, I did give you an opportunity. You didn't take the bait. I told you John Greenwood and I got this thing all right, and you didn't say anything. You were radio silent on me.
I was going to ask you as a follow-up what your prediction is, whether or not you're going to update your prediction with John Greenwood, because you did get it right on the downside as well.
We will update. Well, we haven't really officially done that in writing. However, we did say inflation would end the year at 2.5. The CPI in the United States would end at 2.5 to 3%. It might even come in a little lower than our forecast, but we did at one point in that same model, which we haven't updated. We did say that probably it would go below 2% early in 2025.
Yeah, you did nail the 9.1%, but you did also call for a recession, which hasn't come yet. Are you still expecting that by next year?
Don't hold your breath.
I need to ask you about this letter that Elizabeth Warren and two other Democratic senators sent to Powell on Monday, 2 days ago. Dear Chair Powell, we write today to urge the Fed to cut by 75 basis points. She then goes on to say that, in fact, it may be too late. Your delays have threatened the economy and left the Fed behind the curve, like you just mentioned. Inflation has fallen to 2.5%, well below the mid-2020 peak of 7%. I think she meant 9%. I'm not sure why she said 7%. Anyway, the letter then goes on to say that it is clear that the inflation data is pointing in the direction. Should they have listened and cut by 75 basis points?
Well, first of all, a letter is kind of aggressively interfering with what's going on with the Fed. But forget that. It shows you that the staff who wrote the letter doesn't really understand what's going on, because they're just focusing on the interest rate. They never talked about the Fed's balance sheet. They never talked about quantitative tightening. They never talked about the fact that the money supply is contracting in the United States and growing at a very slow rate. That is why the Fed's behind the curve. So they got the whole reasoning and logic wrong, because the staff who wrote the letter, believe me, the senators had no clue of what was going on. Some staff person on Capitol Hill wrote it, and so the staff person didn't understand anything. And that's my comment on the letter.
Well,
behind the curve is correct.
Why do you think
half of the letter is right? They're behind the curve.
Yeah. Why do you think that letter was even written in the first place?
I think it was written in the first place because they think that we're probably slowing down and maybe going into recession, and at least one of the signatories on that is running for re-election, and that's the last thing you want to do, is be running in an election when your party is the one that caused the recession, or that's viewed. The Democrats are in power. So if you're a Democrat, you sure don't want a recession if you're running. because you want to do anything you possibly can to put a fire hose on the fire and put it out before it gets there.
What astounds me is why this was publicly issued and not just communicated behind closed doors. Because take a listen to this. I'm going to read another paragraph in this letter. While these so basically it says here, at the end of August 2024, the BLS released a preliminary benchmark annual review of employment data, which revealed that there were 818,000 fewer jobs in the 12 months that ended in March. So, well, we didn't speak about that actually on my show yet, but there was a big downward job revision, as you know, by the BLS. While these are not job losses, they do indicate that job growth has been much slower than the data previously indicated. Why would a trio of Democratic senators admit openly that the economy is not doing as well as they initially expected 2 months before an election?
Because they're trying to put the blame on the Fed, which everybody should put the blame on the Fed, by the way. That part's fine, but they're openly saying you're behind the curve. You're going to cause the economy to crash. We Democratic senators had nothing to do with it. It's you. They're basically taking the halo off of Chairman Powell's head. That's what this letter is.
Now, here's the kicker, Professor. The FOMC must cut rates by more than 25 basis points that the Fed officials have already signaled. Immediately after this letter was released, the CME Fed Watch tool on Monday afternoon signaled a higher chance of a 50 basis point cut. My question is, do you think that the Fed caved to political pressure?
Let's put it this way. Correlation doesn't these things you're putting up there are correlated, but correlation doesn't necessarily imply causation. And the only way I could answer that is if I was a governor at the Fed.
So yeah,
I don't know what they were talking about. I don't know if they felt any pressure. I don't know if they discussed the letter. I have no idea internally what they did. We publicly know the letter came out, and there's some political arm twisting going on. And I think the purpose of the letter was to put the blame of an impending recession, if it should occur, on the doorstep of the Fed, not the senators who wrote the letter.
Well, were the senators and lawmakers at fault at all for what's going to come in terms of a slowdown in the economy?
Well, yes, but you have to go way back to when the pandemic hit and everybody goosed the economy, spending money like mad, monetizing the debt and everything else. So of course they had a hand in it. Who produced the deficit? The senators were involved in producing the deficit. Then who stupidly monetized most of it? The Fed. So they're both guilty.
Okay. I like to play
monetary policy is often tangled up with fiscal policy. In this case, it was because the Congress served up the plate with the deficit on it. And who ate the deficit? 90% of it monetized it and bought the bonds that were being sold by the Treasury. The Fed did. And that's why the money supply peaked at an all-time record 27% year over year in February of 2021.
Okay.
And then we had inflation following all of that.
So do you think that we will get quantitative easing again, which is to say much higher growth in the M2 following this recession?
Since the Fed doesn't know what they're doing and paying attention to the money supply, it's your guess as well as mine. The money supply goes up and down, up and down. The last time it was pretty calm and stable was when Greenspan was the chairman of the Fed in the 1990s, and the money supply was growing at pretty close to Hanke's golden growth rate. And where was inflation, David? It was slightly under the target of 2%.
Yes. Okay.
So what I'm telling you works. It's not some academic chalkboard exercise we're going through. I'm talking about the real world.
I think next time you and I can delve or dive a little bit deeper into fiscal policies as well. closer to the election that's going to be
Oh,
important. But for now, let's focus on the monetary side. Let me play for you one more clip to close off. One more clip from the spin room, as you call it, just to catch a reaction to this one. This is interesting.
Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
One more, yeah.
Do you have a reaction to that?
yes, changes in the money supply cause changes in inflation, and bond yields follow changes in inflation. End of story.
Okay. All right.
So it depends on what they do with the money supply, and that will determine what happens to inflation, and that will determine yields in the bond market. Why has the 10-year bond been such a great long trade ever since I recommended trading it when it was yielding 4.8%? Now it's down about 3.7, a little under 3.7. So that's been a huge capital gain, because as inflation came down, the yield on the 10-year came down, David. And when the yield on the 10-year comes down, of course, the price of the 10-year goes up. So whoever followed my advice made a lot of money.
Actually, so if you take it just to your point, I'm going to overlay. This is the U.S. 10-year yield showing it basically since 1981, and I'm going to overlay this with the United States inflation rate year over year, just to see the correlation. And yeah, to your point, there has been a very close correlation between the 10-year and the inflation rate. As you can see, in the early 80s, inflation was very, very high, double digits, and we had double-digit rates. And over the last 40 years, both have come down. So I to your point about the 10-year following inflation, are we ever going to see a return to the 1980s levels for both anytime soon? No. Okay.
Anyway, I have to congratulate you. God, you're the fastest chart gun in town. I mean, how did you get those charts up so fast? We didn't even talk about this.
I've had a lot of practice. This is
Yeah, I would say, as they say about the good guys in the American Westerns, the guy's always the fastest gun in town. Right?
Yeah, you had to shoot at the charts before they shoot back at you. But this is a good chart, isn't it? I mean, it shows inflation and the 10-year pretty much moving over the last 40 years together. That
absolutely, you got it.
Okay. So given your outlook on inflation, then what is your outlook on the yield? That's where I was going with this chart.
Oh, okay. I think in kind of a structural sense that the long bond market is kind of in a, shall we say, a structural bear or quasi bear market. But right now, as a trade, I think it overshot. Yields went way up above the trend, and they're coming down. And the reason they're coming down is that inflation's coming down. So at least in the short run, I think the yields will continue to fall a bit. But I don't think we're going to be seeing that long. Look at that bull market. Those yields coming down. That means if the price of the bonds going up, I mean that. What a bull market that was! From literally, look at that peak back in what is that 1980? The yields.
81, yeah, the yield was 14.5% at the time.
Yeah, I can remember it. You know, I was a little bit younger then, but I was socking a lot of money away in bonds and going to sleep every night, not even thinking about it, and waking up with a capital gain year after year after year.
But you still, I mean, okay, was that still beating inflation though?
Yes.
Okay. Let's finish off on this then. Given your inflation outlook, are you concerned? Well, would you suggest, or how to say this properly? Would you say that inflation hedging is important right now for investors?
Uh, well, it depends on how you define that. That's kind of a loose term. Let's put the question around the other way. Do I think inflation's going to pop up and hit us in the face anytime soon? The answer is no, no, because the money supply has contracted. It's the stock of money right now today is lower than it was in July of 2022, and the rate of growth in the money supply is very, very slow, 1.26% per year.
We've let me end on this final question. We've talked about this before many months ago, but I like to bring this up again because it's been moving. The velocity of M2 money stock has been climbing. Some people have asked you over email whether or not this is going to indicate a return to inflation. What is your answer for us?
No.
Okay. Why is it not as important?
It's not, because you have to look at the whole picture. MV equals PY. M is the money supply, change in the money supply, plus the change in velocity equals the change in the price level. That's 2%. And the change in potential growth Y in the economy, that's about 2.2%. If you solve that identity, David, you end up with a number that's the 6% golden growth rate. So we've already factored that in. That's in the 6%. And the money supply is only growing at 1.26%. So don't get excited about it. The money supply would be growing. If that was a problem, if we would see the money supply increasing at a much more rapid rate than we do.
What if GDP grows faster than expected? Would that change anything?
Yeah, if it would theoretically, it would raise the golden growth rate just a little bit.
I see.
But
okay.
But I don't think it's going to happen. I think actually it's going to be coming in below the potential. The potential for the United States, even if you look at, there are various ways to do this. Let's just take the IMF's latest economic outlook. Over the next 6 years, they say the average growth in U.S. GDP will be about 2.2%, 2.3%. And that's technically, that is about the potential growth rate for the U.S. Over a sustained period of time, the U.S. can't grow more than that. Now, of course, if you listen to Silicon Valley IT people and they talk about artificial intelligence and everything, they say we're going to have a productivity boom. The potential will go up to, some people say 6% or something. I think it's a lot of baloney and hype, but so the potential can change. But if you look at the IMF forecast, that's where it is, and that seems to be pretty realistic to me. Looking at the economy in different ways, you come out always a little over 2%.
Well, I appreciate your thoughts and your candor, of course, as always. People can submit questions to Professor Hanke and myself for our next episode in a few weeks. Where can we reach you, Professor?
On my Twitter, at Steve_Hanke, Hanke, or send me an email. Tell me you want to be on my distribution list for articles that I'm writing and that sort of thing. And that's at hanke@jhu.edu.
Okay, we'll put that in the description down below. Thank you very much for this Fed update and recap. Happy Fed Day to everybody. And next time we can focus on some fiscal policy issues, Professor. And I have some questions on Argentina. The inflation rate's been going down there as well. I'd like to ask you about that, but not today. Thank you very much.
Okay, great to be with you, David.
Great to be with you as
Adios.
always.
Adios, since you're in Argentina.